So the Fed came out with their comments today after the meetings in Jackson Hole, and they were destructive. They're destructive for the market, and I think they will continue to be for an extended period of time. Because essentially what they said is we're going to do whatever we need to do. We will use all of our tools to crush inflation. And I get that, right? Inflation is a tax, and it's a painful tax. And that current tax is somewhere close to 10%. X energy and housing. And once you add energy and housing back into the equation, well, it just gets really, really painful. And that's where we're at as a country today. We're dealing with the worst inflation that we've seen in 40 years. It will get better. Certainly it'll get better. But what I want to do today is share with you my commentary about where we're at, how we got there, and what the future outlook looks like. And I hope that you find it valuable, at least at some level. So it's a PowerPoint presentation that I just threw together. So forgive me if there's errors on it, which there probably is. So the Federal Reserve just crushed us again. Well, let me just back up and say this. Federal Reserve has three primary mandates: price stability, management of inflation, and management of employment. And the other side of the coin is unemployment. And as it relates to any of those, well, I think they failed miserably. Let me show you why. The Federal Reserve injected more than $17 trillion into the U.S. economy alone. And that shows up in a chart called M1. M1 is the primary money supply here in the U.S. And they undertook an experiment without the vast majority of us aware of it, that has never been undertaken before in the history of the U.S., not in the history of the world, I don't think. Maybe in Zimbabwe and their hyperinflation, and maybe in Weimar Germany after World War I. But besides that, with a functioning economy, this has never, ever happened before. So they not only injected all that capital, all that liquidity into the marketplace to stimulate us, by the way, and in their defense, I will say that action needed to be taken in the early days of the pandemic. We were looking at a complete shutdown of our U.S. economy, which would have inevitably led to a deep recession, if not a depression. So there was good reason to do what they did, but not to the extent that they actually took action. The other thing they did is they did quantitative easing, which is one means by which they increased the money in circulation. But QE, particularly in this case, they bought corporate bonds, including toxic assets, and they bought mortgage-backed securities. And in doing so, the latter part, mortgage-backed securities, they artificially lowered interest rates for virtually every product out there, whether it's a home loan or a car loan or a corporate loan or whatever. They artificially lowered those interest rates. And in doing so, they double boosted the economy. So the injection of liquidity, the lowering of interest rates artificially led us to the greatest boom that we've seen maybe in this country ever over a very short period of time. And most importantly, they did this on the back of a broken economy, right? We were in the midst of lockdowns, and we went from being deeply wounded to the best 2 years ever. And that's starting now to come back and bite us. And the Federal Reserve is going to play a major role in how that happens. So here's a chart of M1. M1 is, again, the primary money supply, which is the money that's in your pocket, the money that's in my pocket, the money in circulation that's in your bank account, your safe deposit box, your safe, whatever. It's the money in circulation that's readily available to you. It's liquidity. As you see here, going back to 1960-ish, there's been a steady rise in M1, and that's natural. As our population grows, as we have more businesses, as our economy grows, it's necessary to have more liquidity, more cash in circulation. You'll note here in roughly 2010, on the tail end of this great financial recession, we took the M1 from about $2 trillion to $4 trillion. And we did it over a 10-year period. That was an experiment that many, many people were deeply concerned about. As you can see, it's never been done in the history of the U.S. the Fed chairman at the time was Ben Bernanke, and he ended up with a moniker, Helicopter Ben, because it was essentially throwing money out the window, trying to get people to spend. And getting people to spend and corporations to spend is an important aspect in our economy today. In fact, 70% of our GDP, gross domestic product, is as a result of you and I spending our money on cars and houses and TVs, appliances, and services as well. So he stimulated the economy and did so in a great way, in a very measured way, right? I mean, he doubled it, yeah, but over a 10-year period. Here's where it gets really freaking scary. Almost overnight, we increased M1, the money in circulation, by 500%, over 500%. And that is the primary driver behind asset prices across the board. And as you well know, if you've not been living under a rock, asset prices have just exploded almost across the board. And it all happens immediately after this money was injected into the economy. So you saw house prices explode. And look, there was this argument, well, they're exploding simply because there's not enough supply. And there's an argument that says that's probably right, but only to some degree. We didn't go from an oversupply of houses to a massive undersupply of houses overnight. What happened is we just massively increased demand for those homes, simply because we, again, artificially lowered interest rates and over-injected liquidity into the economy, stimulus, PPP, and a variety of other means that the government undertook, or the Federal Reserve undertook. I shouldn't say government, because the Federal Reserve is not part of the US government. They're an independent for-profit entity that is intended to operate independently from the US government. So this is interest rates, right? Going back about 40 years, where they peaked during Paul Volcker's position as the head of the Federal Reserve, also known, by the way, as the central bank. You'll hear those terms, and they're both essentially mean the same. But Volcker, in an attempt to crush inflation, increased rates. Interest rates peaked at around 19%. And that includes interest rate on the homes, single-family home loans, right? Can you imagine that? Well, so over the course of the last 40 years, we've seen a very consistent reduction in interest rates. And that makes all the sense in the world. And the reason is simply this: we are able to better underwrite, through all the data that we're collecting, risk and reward. So we can reprice risk, and in doing so, reduce interest rates. We also, as a country, and I've been a banker and an investment banker in my past lives, we are able to offload that risk in the form of mortgage-backed securities. One of the things that, in fact, drove the great financial crisis, mortgage-backed securities of all subprime loans. Now, the difference between then and now is that we were lending whatever. We were lending millions of dollars, billions of dollars to borrowers that didn't have the ability to keep those debt service payments current. In other words, they were never able to make the payments. What they're hoping to do, though, is flip the home, because price appreciation was so dramatic and rampant. And you bought a house, and 2 months later, you're going to sell it for $50,000 or $100,000 or more above your purchase price. So, but look what happened when the Fed stopped doing quantitative easing here. Interest rates hit what is arguably a level of equilibrium, where price action is equivalent to demand and supply. We don't know where interest rates are going to go from here, but here's the scary thing. Some of the tools that the Fed has in their pocket one of the tools, I should say, is known as quantitative tightening. Quantitative tightening basically means that instead of buying those securities and artificially reducing interest rates, they're going to sell those securities and artificially increase those rates. And in doing so, that's going to further exacerbate what is currently being called the recession in housing. One of the primary drivers behind this massive increase in single-family home prices, in fact, asset prices across the board, is that debt was really, really cheap. People were paying less attention to what the cost of the house was and more attention to what their monthly mortgage payment is. And frankly, I mean, there's some logic to that. Housing is intended to be just that, a housing. It's your structure. It's where you raise your family. And so there's a cost associated with that. And that cost is really a function of price of the home and also the interest rate that you pay on your debt. And unfortunately, over the course of those 2 years prior to June 2020, home pricing, in other words, the cost to inhabit a home went up 85%. And that was a function of increase in interest rates and increasing house prices. And so the natural reaction going forward is simply going to be that price action is going to continue to go lower and lower and lower. It's more likely than not. Look, I mean, nobody really knows. I'm sharing with you my thoughts, but the fact of the matter is there's a lot of things that are not predictable that are occurring in our economy today, what are known as black swans or fat tails, the tail end of a bell curve. And we're seeing events happen at those fat tails, and we're seeing black swans literally all over the place. Bitcoin hit $64,000. That's ludicrous. I did an article and a video on this back in September 2021. And what I said is, look, Bitcoin costs about $8,000 to create, and it should not be trading at 800% of that price, right? It just doesn't make any sense. And obviously it's retraced since then, but this is not commentary about Bitcoin. I don't invest in it. I don't recommend people invest in it. I don't think it's a currency. I think it's more of a commodity and investable tool. But the price action is so volatile that it's a little bit like throwing the dice. So anyways, this issue of interest rates has been one of the primary drivers in the price actions we've seen across the board on all asset classes, whether it's stocks, global equities, U.S. equities. Price of lumber here in the U.S. was up 600% at one point. Houses, used cars, new cars, commercial real estate certainly participated in it, particularly as it relates to industrial and multifamily. So look, these actions that the Federal Reserve took created all the bubbles that we're experiencing here in the US. And those bubbles are now disinflating. And I don't know if that's the appropriate word, but that's what comes to mind. They're disinflating. Bubbles don't pop. They don't do that, particularly asset bubbles that are tied to long-term asset investments like single-family homes or commercial real estate. It takes years for those overvaluations to unwind, and more often than not, they unwind below the mean. In other words, they're going to overcorrect. So kind of that's my thinking at this point, at least. Housing market is about to get way worse. I just shared that with you. Blame the Fed. Yeah, the Fed's primarily responsible. They created these bubbles across the markets, and now they're going to be the primary driver behind crushing these bubbles in the markets using the tools, again, that they have available to them. They'll continue to ratchet up the Fed funds rate. By the way, if you don't know, the Fed funds rate is basically the money, the rate that banks borrow from the Federal Reserve for overnight lending. It's not a particularly important rate from a variety of perspectives, but it's definitely a key driver here in the U.S. economy, and in part because we take action based upon, the Fed's moving another 75 basis points. Well, to you and I, it doesn't affect us. It will eventually affect your credit card loans and your mortgages, et cetera, simply because if banks borrow at a higher rate, they have to lend at a higher rate. But the banks are so flush with cash at this point that there should not, in fact, be an immediate effect. So again, when they start doing quantitative tightening, which is my second bullet point here, we're going to see additional increases in those interest rates. The Fed absolutely, Jay Powell came out and said very precisely that they're going to do whatever it takes to crush inflation. And in doing so, what they're going to do is crush our economy. And so they way overreacted as it relates to stimulus, quantitative easing, and printing. And now they seem to be way overreacting as it relates to tightening. pulling capital, pulling liquidity out of the marketplace, because it's going to affect every asset class going forward. I mean, there should be no question about that. Interest rates have a direct effect on virtually everything that occurs here in the U.S. economy. Yeah, and look, as I said earlier, inflation is a problem, but we're already in a recession. A recession, again, is traditionally defined as 2 or more consecutive quarters of negative GDP growth, and we're already there. The Fed will argue, or the U.S. government, I should say, will argue that that's not really inflation. That's not really a recession because unemployment is so low. Well, there's a whole story around unemployment being so low today. It's in part as a result of so much liquidity in the marketplace. It's today an employees market. They get to dictate to a very large degree the terms under which they work. They ask for more capital. They choose to work from home. And they're not coming off of that position, not at least very quickly. But as this recession deepens and the market correction continues to occur, which is more likely than not, of course, we're going to shift to more of an employer's market, meaning the employees are going to be forced to go back to work in their offices, in their whatever. They're going to be forced to be in attendance in the business they are part of operating. The overall net effect is that we're going to be looking at a lot of choppy price action across virtually all asset classes, and more likely than not, the general trend direction is going to be downward. As I mentioned, they tend to stay the course and moderate the very inflation that they caused. They'll crush the economy. At least that's my opinion. You can't pull liquidity out of an economy without having a direct effect on both income and asset prices. And that's what we're already starting to see. Stock markets reacting. And that's probably the most liquid of the assets that we're going to see the huge effect of the Fed's intervention, if you will. So, yeah. Bubble of everything. That's a tough place to be. This will be personally my fourth downturn. I've been in the business of investing in asset management for close to 30 years. This will be my fourth, and this is the one that I am most concerned about, inclusive of the great financial recession. That was a single bubble that popped, just one bubble, single family homes. And in doing so, it took down huge enterprise like Bear Stearns and Lehman, amongst others. This is the bubble of everything, guys. I mean, there was no single asset class that didn't participate in price inflation. And so you just really need to expect there's going to be some price deflation. And in doing so, by the way, that's going to lead to disinflationary times. In other words, this inflation issue that we're dealing with today, it's going to go away as this recession and correction deepens. It's just the nature of things. We as consumers spend less. So here's one of the things that drove all those asset prices through the roof. We spent a lot, and we spent using both Federal Reserve liquidity through PPP, Fed stimulus checks, et cetera, but also using credit. So credit's at an all-time high. I mean, yeah, we've never seen anything like this before. And here's the bigger problem. Consumer sentiment. Consumer sentiment drives economies. Again, as I mentioned earlier, we're a consumer-driven economy. 70% of the GDP is derived from you and I spending money on goods and services. Well, when consumer sentiment hits an all-time low like it is today, based upon recorded history, we haven't been recording this for much longer than the early 80s, or just before the early 80s. We're at all-time low. That means you and I, friends, are less likely to go buy a new car, buy that boat, take that vacation. We're seeing it happen already today. As an example, I went and looked at booking a cruise the other day, and I was blown away by the prices. I think it was $46 a day for room and board on a boat and food inclusive. I can't live that inexpensively anywhere. Not that I want to, but being on a cruise and being catered to for an extended period of time sounds really pretty interesting. So Here's the thing to know. Crashes don't happen overnight. People talk about, October of 1929 and that giant crash, but that was only the beginning of a correction. It took, I think, 3 years before the equity markets, stock markets bottomed out. I kind of think you should expect the same thing here. One of the things to note about that, by the way, is that equity markets are also emotional based. When talking heads on TV, whether it's Jim Cramer or somebody else, say, this is the reason why today markets are acting or reacting the way they are, you need to toss that right out. In fact, my recommendation is you don't watch that crap. Not that they aren't good at what they do, but the reality is price action is more a function of the way big money, like hedge funds, are thinking and investing or not investing, and also the retail investor. Oftentimes it's an emotional issue. And so once we start to see a massive slide to the downside, you tend to see it snowball, but it's going to snowball over a period of time. The other thing to think about as it relates to the equity markets is that price earnings ratios are going to compress, and then earnings themselves are going to compress over an extended period of time. If you agree that the consumer is the primary driver behind the US economy, then you'll have to simply agree that the economy is in for some challenging times, given the high level of consumer debt and the low level of consumer sentiment. Corrections? Look, I don't know. I have no idea. I wouldn't have thought our economy would explode on the back of a broken and wounded economy. But I was obviously wrong, and I could very easily be wrong here. So whatever I'm telling you, take it with a grain of salt. But historically, we've seen real estate take a huge hit, particularly single family homes, but also commercial real estate, which is very near and dear to my heart. We've added 40% in terms of valuation over the course of the last 2 years. My personal objection or projection is that we're going to not only retake that 40%, but we're also going to overshoot. Markets are known to overcorrect to the downside. The only time you hit the bottom is when you have absolute market capitulation. In other words, people just give up hope. There's no faith, there's no hope. And so assets go back to the banks, they're sold at discounts, which triggers other assets to go back to the bank, and those are sold at discounts. I call that a downward spiral, and it happens more often in commercial real estate than it does in single family, because commercial real estate is an income producing asset versus single family homes, which is, again, a place where you live. So equity markets easily overcorrect to the downside and maybe lose as much as 60% from their peak values in earlier this year, 2022. Anywhere, is there good news? Please tell me there's good news. And the answer is, of course. More money is made in a downturn than there is made during an upswing in the marketplace. That's because assets, income producing assets, go on sale at massive discounts. And that's something that I want you to think about taking advantage of. So what does that mean? It means that you need to husband your resources, understand your asset, understand your balance sheet, know your liabilities, and say, okay, I'm going to consider and reinvesting in the marketplace at some point in the future, and know what assets you have to deploy into that investment. And it could be single family homes, which I'm not a huge fan of. They've done extraordinarily well over the last 40 years, but that's simply a function of a growing population here in the US, probably underproducing homes, and declining interest rates, which makes higher priced homes more affordable because the monthly mortgage is less. So whether it's single family homes or commercial real estate, which again is really near and dear to my heart. I love commercial real estate because it's an income producing asset that is relatively inflation resistant, and it has compounding returns. It's also, depending on how you invest, arguably a passive investment. More importantly, the tax benefits of owning commercial real estate are unmatched in any other investment that I'm aware of, at least in the world. You get huge tax benefits as a result of investing in commercial real estate. As an example, the depreciation can be accelerated. You can aggressively accelerate not just the building itself, but some of the improvements in the building. And of course, you're going to have to recapture that at some point. But cash flow from commercial real estate is certainly a primary driver behind 80% of the wealth here in the US. Did you know that commercial real estate has outpaced the S&P in terms of returns by an order of magnitude like 700% over the last 100 years? So bonds, just simply put, bonds earn 1 to 3% return. Equities like the S&P or Dow or NASDAQ in aggregate, and I'm not talking about individual stocks, but in aggregate, earn somewhere between, I don't know, 6 and 8%, including the cash flow. Commercial real estate is in the 20% range, and that income is often protected from the beneficial tax treatment that they receive and deserve, frankly. Be in a position to do that. If you'd like to know more, I will share my contact information with you. I do a masterclass and a mastery class on how to invest in commercial real estate. It is, again, been the leading creator of wealth here in the US, and it's about to go on sale. I'm seeing some discounts in commercial real estate that I have never seen before. So follow the logic here. Some of the best investors in the world, the Rothschild family, buy when there's blood on the streets. The other half of that equation is even if it's your own. And Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. So be contrarian. Invest in asset classes that are out of favor. And today, a really great example of that is office buildings. I'm seeing them trade at prices that are literally a fraction of their replacement value. And whenever you buy an asset at less than replacement value, you know you're generally getting a good deal. It's not a blanket statement. You can't make that an absolute investment strategy. But if you're buying it less than replacement, you're at a really good starting point. I covered all this. So just to kind of give you some feedback on me, I've been in the business of investment and asset management for more than 30 years. Done more than $11 billion in total transactions. And I generally am involved in distressed commercial real estate. When things get bad is when I get really busy and when I create an extraordinary amount of wealth. I'd like to share that with you. So feel free to contact me, like and subscribe on the video. I'll be putting out much more content going forward. And I wish you a great day. Fear should not be the primary emotion that you're feeling, my friends. It should be opportunity. Opportunity is ripe, and it's literally right around the corner. Again, it's going to take years before we unwind the mess that we're in today. It's going to take somewhere between 2 and 3, and maybe even 4 years before we eliminate that excess liquidity in the market and understand then what the true equilibrium in terms of price action is, where supply meets demand. But that doesn't mean you're not going to see extraordinary opportunities along the way. So thanks for stepping in. Thanks for watching. Leave some comments. I'd love to hear what you have to say. And again, have a great day.